We're back. It's Thursday. You know what that means. Taxes on Sub2 specifically, but just taxes in general. If you've got tax questions, today's your day. So get your next cup of coffee or Mountain Dew or whatever it is you like and meet us back in 45 seconds. Good morning, Sub2ers. It's Thursday. It's time for our weekly Goat Talk Facebook Live. We've been gone for a couple of weeks. Jody and I had our anniversary and took a vacation, but we're back. We're ready to talk about taxes. You guys let us know who you are if you're here with us watching, where you are, what kind of investing you do. We'd love to say good morning to you. If you're watching on Facebook, we'd love to ask you to subscribe to our YouTube channel. You can do that at sub2tv.com. We release a video almost every day, some type of investing tip to help you with Sub2, any kind of creative finance. And download our free creative finance guide. You can go to sub2deals.com/CFG. We put together a book for you to show you 4 different ways to buy houses with no banks, no cash, no money in a lot of cases. So this morning we're talking about taxes. You know, it's about that time. Middle of next month, it'll be time to pay Uncle Sam if he files your extension in January. And we hope you did. It's always better if you got to pay it later. I think our guests would agree this morning on that. But we're going to go ahead and bring him in. We've got our buddy Bill Walston here. Hey, Bill, how are you?
Hey, guys, how you doing? Coffee.
Ginger ale.
Oh, well, beverage of choice. Beverage of choice.
That's right. So, gosh, taxes, Bill. Go ahead. You know, there may actually be some people on here that haven't met you before. Introduce yourself. Tell everybody why you're a tax and well, God of many things, I guess, in real estate, and why you're the expert this morning.
Well, from a tax standpoint, my undergraduate degree is in accounting and finance. My master's degree is in tax law. Okay, and I sat for the CPA exam many, many moons ago. Would not want to have to take that sucker again, right? But I actually had a CPA practice. That's what I started right after graduation. And then I think you know that story. Circumstances. Most of my clients ended up being real estate agents or real estate investors, and I saw the money and profits they were making. I said, I think I might better try this out. And so I sold my practice out and started real estate investing. So I'm like about 35 years or so into that. And my clients kept calling saying, hey, look, any of these accountants can do our tax returns mostly, but we need the tax strategy, which is what I was very good at. And so that's what I continue to do now. So I'm working with real estate investors with tax strategies as well.
Yeah, awesome. So I've known Bill for years, and we've had him on numerous podcasts and just wanted to have him on this morning. We've gotten a lot of questions recently about taxes as they relate to Sub2 specifically.
Yeah,
so
just about any creative deal has tax ramifications for the seller, the investor, and not as much the end buyer. Okay, but they may, if that end buyer is also an investor, right? So it kind of depends on the position you hold in the chain.
Yeah. So we wanted to bring Bill on to talk about those things, but and any tax questions that you've got related to real estate. Good morning, Ryan. Got your message this morning. I'm going to get back to you. It was really close to our start time here. Just want to let you know that. But good to see you on. We've got Vincent out in Houston. Great to see you. Amanda, Good morning, Amanda. Amanda's our latest Sub2 Max student. So
Oh,
good
cool.
to see her on here this morning. So great. All right. Well, guys, if you've got questions, let us have those. We'll get to those as we work down the list. So, Bill, let's get started on that.
Okay.
Tell us about, we know Sub2, and this is one of the things I try to explain to people. It's just an acquisition method, really. It's a form of financing. It's not magical or anything like that. But taxation. Now, if I go out today and I buy a property for $200,000 and I get bank financing for the majority of it, almost all of it, I put a little bit down. How is it different if I do the same thing, but I take over a property subject to and take over that mortgage and maybe give the seller a couple of $1,000s down and take over their payments? How are my taxes any different with that?
They're really not that different. Okay.
Mm-hmm.
A sale is a sale.
Right.
And if you're taking a property subject to, the difference is in how you're paying it, right?
Mm-hmm.
And how the sales price is calculated. Okay. So the seller, of course, is the one that's going to end up paying the taxes on the sale of that particular property. So they're more interested in how the sales price is calculated. But as far as a Sub2 deal, your sales price is based on the underlying loan plus any cost associated with it. So if you're paying reinstatement fees or interest or paying the seller some cash or something like that, that's added to what we call your cost basis for the property.
Right.
Okay. So the sale is essentially the same. Seller's still going to have to report that transfer of the property as a sale for that property and would be subject to any tax consequences that might be attached there too. Right. So his gain is basically going to be the difference between the computed sales price, which would be the underlying loan value and any money that you give to him, right? And then whatever his cost basis might be.
Right. So, and I know this from years previous of struggling with QuickBooks and trying to all my cheat sheets on how to make entries for purchases. But you book those now we're talking from an investor's perspective. Now, if I'm buying houses,
right?
There's no difference in how that goes on the books.
No, there's not.
Nothing.
There's no difference. No difference whatsoever. I mean, it's not a big mystery. A purchase is a purchase. Right.
For sure. Now, that being the case for the seller, and really, correct me if I'm wrong, you're the tax expert here, but their sale, their tax consequences also doesn't differ in any way from any type of sale. The only difference is, was it their principal residence? Was it an investment property? Have they pulled more money out of the property than their cost basis over time? All of those things will remain the same regardless of if they sell it Sub2 or it's a regular sale.
Right. Depending on whether they are an investor or not. Right. So, for instance, you usually do not have to worry about a large gain if someone is selling what's their primary residence to you, right? Because they've got the Section 121 gain exclusion. Okay, so if you're selling your primary residence, if you're single, the first $250,000 of gain is not taxable anyway. And that's going to still be the case. $500,000 if you're married filing jointly. So there are not a lot of folks, especially in the types of properties that we may be buying, where that's going to be an issue, right? Where they're going to have a lot of gain on the property. The difference is going to be if they are an investor who is selling that property, right? Because as I said, their gain is going to be the difference in the calculated sales price. Okay, and their cost basis. Okay, and the way they have to recognize that gain may be different as well if they're an investor. Because if they are an investor and they're selling you an investment property, Okay, if they're doing that, then they can use the installment sale method. We all talk about how we love that installment sale
Right.
method. Well, the reason we love it as investors, and the reason your seller would love it as an investor, is because they can spread that gain out over the life of the contract if they
Right.
can elect installment sale basis. Okay,
Right.
the difficulty is if they end up being classified as a dealer.
Right.
Okay, if you get that dealer classification, then you cannot sell a property on an installment sale basis. And where the real kicker in the butt is if we do sell it with owner financing and we get to collect that money over a period of time instead of all in 1 year, if we're classified as a dealer, we've got to recognize all that gain in the year of the sale, whether we got that money or not.
Right.
Okay, so we have to pay taxes on money that we've not even collected.
Right.
Which is a big pain in the keister.
Yeah, you have to pay it in advance and then still collect it over 30 years or however long you financed it for.
Or how long you finance it.
But and we're talking about dealer status now, so that's getting and just something that's a little bit more complex. But you and I have talked on podcasts before about several ways to you have to be careful with the words you to avoid
dealer status,
you being classified as a dealer as opposed to individual transactions,
right?
Perhaps, which is much better,
right?
But yeah, and of course you have to. Again, you correct me. I know tax law changes all the time, but you have to. You claim your sale in a certain way. Whether when you declare it, either a dealer transaction or an installment transaction, and it's going to be up to an audit, I guess.
Sure.
Otherwise,
and our favorite expression, it's a moot point unless you get audited.
That's right.
Right.
That's right.
But there are some situations. Basically, you kind of look at it. A lot of times, you have to look at frequency and stuff like that. But the big difference is if you have a dealer classification, okay, then you're selling inventory. Okay, IRS looks at those properties just like an inventory item, right? And so they're not a capital asset, which means that you don't get capital gains treatment on the sale of those properties. Okay, so that's just out the window, which means that your income from the sale of those properties is subject to self-employment tax. Okay, and I'm sure most of you heard like wholesalers, right? You're not a real estate investor, you're a dealer, and that's true. If you're nothing but a real estate, if you're a wholesaler, you're doing dealer transactions. Period.
Right.
I don't care really how you look at it.
That's buying with the intent to immediately resale. That's not investing at all.
That's right. And really that's how IRS looks at it. I mean, they actually, it's section 1402, which you guys aren't really need to worry about that. But for me, it's kind of like geeking out, right? So that's one of the places that dealer status or a dealer is actually defined. And they say it's an individual who is engaged in the business of selling real estate quickly for a gain and profit. And when you look at, hell, we're all buying property for a gain and profit, right? But they kind of classify it as the frequency and whether you're holding any of these properties for investment purposes or not. So that's what they kind of look at. So you have to take steps try to avoid that step as a dealer. And basically what we're doing is CYA work in case you ever get audited, because the hope is we're going to report it the way we decide to, one way or the other. And then we need a defensible position if we get questioned about it. If service ever comes in and says, you're selling too many of these, like one behind the other, so we're going to classify you as a dealer, and we're going to go back and reclassify everything you've done for the last 3 years. So,
do you know of cases where they've come back and reclassified every transaction? I've more often heard of cases where they would classify individual transactions.
Again, it goes back to what they consider your intent to be, right? if they go back and let's say you've sold 5 different properties and you treated all of them as investment properties, and the service come back and only reclassifies one of those as a dealer, consider yourself lucky, because that's not usually what they're going to try to go in and do.
You know, we could do an entire show on this, on dealer status, but a tip I think to share today is you actually start with you start setting the tone for your business when you're writing up your articles or whatever, when you
your operating agreement.
Your operating agreement.
Absolutely.
And what your intent is with your business.
Right. And that's why with a lot of my clients, when I go in, one of the first things we do is review their operating agreement and take a look at it and say, dude, just your bare operating agreement is classifying you as a dealer. I've seen contracts. Well, you remember the old contracts where we said, oh, we need to disclose everything. So we make sure that we put in the contract, buyer intends to sell property for a profit.
Yeah.
And we thought that we were, we were being kind to the seller and letting them know what we're going to do. Dude, you just signed your death warrant as far as being classified as a dealer is concerned, because that's exactly what a dealer does.
Yeah, for sure. Okay, let's see. We've got a question here from Vincent. I have a flip that's been going on for a year now, many complications. Can I write off the interest-only payments I've been paying to hard money?
Yes.
That's a holding cost for you.
That's Yep. That's a holding expense. And it's an ordinary business expense. It does not have to be added to the cost of properties.
Right.
And that's what some people would try to say is that, oh yeah, that's, that gets added to the basis of the property. I would say no, I'd just write it off.
Yeah. That's just an expense. Anything that you have to spend, of course, improving the property is going to be cost basis. But holding costs, taxes, everything else that you pay during that time that you have it, that's just should be just a write-off for you.
Yeah. Now, some accountants, I tend to be a little more aggressive. I think you know that. Some will say that anything that you have to do until that property is ready to sell or ready to put into use, et cetera, it's all going to be classified as part of the cost of the property. Especially in flips, I don't think that's the case. If you have to, because look at it, okay, your property is an inventory item. And if you had a pizza shop and you were buying inventory and you had to take out a loan to purchase some of that inventory, the interest that you write, you don't add to the cost of the pizza.
Right.
Okay.
Yeah. It just makes sense. Anything that improves it or adds to the value of the property would
materials, go to things like that, you would add to the inventory, but not holding cost or carrying cost, rather.
Okay. Morning, Matt Smith. Good to see you. I'm not sure who this is. Morning, Bills. Let us know who you are so we can say good morning to you.
That might be one of you goat gals.
Yeah, it might be. I would think maybe Cindy or Sarah. Cindy, I think Cindy doesn't like to let Facebook know who she is over here. So it might be her. I think. Oh, she doesn't. But I don't know. We'll see. Let's see. Bill, I have sellers always asking me how this will affect their DTI when it comes to me buying on Sub2. What can you recommend?
Oh, it's definitely going to affect their debt to income ratio because the loan's still in their name.
Right.
Okay. And it depends on the lender. It depends on how old how long the loan has been seasoned. Right. Because after a year, if you have been consistently making those payments, it's not supposed to be included in the DTI at all.
Right.
Up to that point, a lot of times they'll give 75% of the income can be offset or added to your income in order to offset the DTI.
Okay. So just like a rental, and that's the way you have to present it to them. And, and part of it's going to depend on who their lender is.
Absolutely.
Yeah, for sure. So some are more flexible with that, but tell them, if the worst case scenario, they should be able to get it treated just like they rented their house out. Okay, so Facebook user still unidentified, but says they're
this is a dude. So it's not one of your goat gals.
Yeah, Yeah.
Sorry, we can't tell
We,
from Facebook user.
that's right. We can't identify. Facebook StreamYard isn't saving my info. Well, just tell us who you are if you don't mind, so we can say good morning to you. Okay, next thing on the agenda, and guys, if you're just joining us, we're talking about taxes and Sub2 specifically, but if you've got some other stuff, throw it in here and we'll be glad to help you out this morning. The next word that's come up a lot lately is phantom tax and how that affects your seller. So you want to go into a little detail about that and how it could work?
Oh, sure. That gets back basically to the same idea of if the loan exceeds the basis of the property, right? There's that gain in there, and the seller is going to be taxed on it, even though they're not getting any cash.
Mm-hmm.
Okay, and that's if you're taking a property sub-2 and they're not getting anything at all. Remember, a lot of times we go in and we do a sub-2 deal, okay,
Right.
and we will take a look at that transfer. The seller's not getting anything at all, right?
Mm-hmm.
They're just conveying the property over to us.
Mm-hmm.
Okay, but what they've got to do is look at the basis of that property and compare it to the loan value. The other thing they've got to look at is Internal Revenue Service says, hey, if they're no longer having to make that mortgage payment, okay, then that's treated like a cash payment to them when you take over that property, right? It's treated like a cash payment to them.
Right.
And so that's another way they pick up phantom income.
Mm-hmm. Okay.
So what they're, and the one rule, the exception to that, way it's treated as phantom income is if you take the property and you give the seller a wrap mortgage. Okay, because the IRS doesn't look then as that mortgage assumption, the sub-2 mortgage. They treat that as a cash payment. On a wrap, they do not treat the underlying loan as a cash payment.
Right.
Okay, so it's not taxed.
Right. And you can easily do that even with a seller that's not getting anything by just making it what we call a mirror wrap.
A mirror mortgage or a mirror wrap.
Right.
Okay?
Mm-hmm.
Those old terms. Not too many people talk about those.
Well, they probably got a new name for it today. They named it after some animal or something. It's probably the frog method or
the frog wrap.
Yeah, something like that.
Something like that. maybe the python wrap or something. Or that would be a squeeze, right?
Yeah, that's right. Maybe it is. But basically what that is, guys, is you just mirror the terms of their mortgage. If their mortgage payment is $750 a month and the seller's not getting anything and they owe $180, then you sell it to them on a wrap. You create the new mortgage for $180 with the same terms and same payment.
Payments be the same. Interest would be the same. The difference is that you have a written obligation to them. For sure. And they're holding a note, so you're not just taking over their note. Right. You're paying them on a note that you're giving to them or a mortgage that you're giving to them.
And remember that 99+% of the time when we talk about the differences and phantom tax and different taxations between owner occupants, homeowners, and buying from an investor, the vast majority of the time you're going to buy from an owner occupant and not an investor. I have
not an investor.
I
cannot remember the last time I took a property subject to and it was from another investor.
I've never done it.
They're just like us. They want their cash too.
They want control. If they're any kind of investor, they want to stay in control. They're not going to do a sub-2. I've bought very few properties from investors, period. I mean, I could count it on both hands and have fingers left the number of times over the years, because the best deals are always going to be direct to seller anyway.
Yeah, especially if it's a single family. Now, multifamily, those would be investor deals. Mm-hmm. That would be an exception. But most of the time now we're talking single family homes. So
Mm-hmm. Okay, so we have some other things that we were going to cover, and of course we'll still answer specific questions on this sort of thing. But as far as tax questions about sub-2s that people have, – so I know you have some of those that we were going to go over today.
Well, we were talking some about the dealer status and the or disadvantages of dealer status, right? We did bring up that and mentioned that it was ordinary income and not capital gain. I think I also mentioned that you do not get the advantage of an installment sale. The income is subject to self-employment tax. You can't do 1031 exchanges on properties for that. So those are some things to consider. What was the other one? We were talking about, who gets the depreciation and interest? That was a question I get quite often on a sub-2 deal. The buyer gets the depreciation, right? So let's say that you're taking a property subject to a single family home. You're going to hold it as a rental, right? You get the depreciation expense on that property. Okay, so you want to make sure that and another big one is who gets to write off the interest. A lot of accountants don't know about this one. It's especially important this time of the year. Okay, the payor gets to write off the interest. Okay, and Internal Revenue Services actually come out and said in one of their regs, it's 163-1B, right after the ordinary business expenses. Everybody knows about Section 162. Section 163 actually covers who gets some of these expenses, and they came out and said that the payor doesn't make any difference whose name the loan is in. Whoever's paying the loan gets to take the interest expense, right? And that's fine for them to say that, but the kink in that is who gets that 1098 form, right? That's usually the seller, right? It still comes back to them because the loan is still in their name. Okay, so you just got to let them know they don't take the interest expense, right? You take the interest expense. One problem that will sometimes get people audited, right, is how you report that interest. You cannot report that interest as mortgage interest. And that's where a lot of investors make the mistake. You know, on Schedule E, let's say they're doing a rental property. So they got their property listed and they say, oh, okay, sellers told me that this was the amount of interest that was paid during the year. Okay, and it was reported on a 1098. So they stick that on as mortgage interest. That's not your mortgage. So you can't put that on the line that says mortgage interest. It goes on the line that says other interest. So don't ever report interest that you're paying on a sub-2 as mortgage interest, because Internal Revenue Service tries to match mortgage interest to 1098 forms. Okay, and they can't find one in your name for that amount of interest. And when that gets flagged, it might stir up an audit. If you put it on other interest, then they're not looking for a 1098 form on there. So that's how you're going to want to report that.
Vincent has a question here. Is it possible to change the mailing address for the mortgage so I get the 1098? Vincent, that's what I was going to suggest, is when you change your address, and this is some advice that I give everybody to do this, and I tell them to do this for a couple of reasons. But when you change the address, the mailing address associated with that mortgage, like here's one we got under contract yesterday. I'll tell you, Rocket Mortgage. We're going to fill out the change of address. We're going to change that. It's going to be from Joe Seller to our address. It's going to be Joe Seller in care of W. Tingle. My name is going to be on that. So every time that piece of mail comes, it's going to say Joe Seller in care of William Tingle at our address. And what that's going to do is any correspondence from Rocket Mortgage, in this case, is going to come to us. It's going to be addressed to Joe Seller in care of. So my name will be right there on that piece of mail. That means you'll get that 1098. So you don't have to worry about tracking down the seller trying to get that. There's no confusion. But I'll tell you, I was in a mastermind. This is the reason we do this. I was in a mastermind. It's been 15 years ago now, with a guy who did hundreds and hundreds and hundreds of deals in one particular state. You may know who this person is, Bill, but he was pretty well known. He was a really big investor. And if you've been around for a while, if you make the right people angry, they're going to get you. I mean, they're going to find. I mean, they got, everybody's heard of Al Capone, right?
Yep.
Okay. You know what he finally went to jail for?
Tax evasion.
That's right. If they want you and they can't find, I mean, they all his criminal activity, they couldn't find a way to get him. But so what they got him on taxes.
Tax evasion.
This guy that I was in this mastermind with had actually gone to prison, and they didn't get him for doing anything wrong. But what they finally got him for was, I can't remember the exact charge, but he was opening mail addressed to other people because he didn't include
mail
that
fraud.
care of. And that's how they sent him to jail because, well, they were angry for other reasons, but that's what they got him on. So, and I learned that tip way back then from that guy. So we get.
You remember Wade Cook?
I do. Yeah.
Similar.
Same thing. Okay.
Similar.
And I can tell you some stories about other guys. I tell my Max students about a guy that had found a way to get overages directly from the county that weren't getting claimed. And I'll tell that story again another day. But anyway, I mean, same situation. The state, he was costing the county millions of dollars a year because this guy was big time. And they finally sued him on a consumer protection law, even though no one had complained, right? So you got to be really careful with some of this stuff. But that's one of the things. Make sure everything's coming to you that would have normally gone to the seller because you need it for your business. And this tax form is one of them. But you make sure it says in care of Vincent. Okay. Make sure you're doing that. Hey, good morning, Corey. Good to see you. Let's see. And then we've got another comment here. Drew says it won't confuse your mail person. That's correct. It won't. So it's an important thing there. But Bill's answer was if you pay it, you get to write it off. But
pay it, you get to write it off.
Depreciation,
you get to take off because you have taken all of the burdens of ownership. You'll hear that referred to.
Right.
Sometimes the instance and burdens of ownership, right? And if you have those, then you're entitled to the depreciation expense. So that's how they justify that for all practical purposes, you are the owner. And in this case, you would be because the deed's in your name.
Right.
Right. Or in your trust name.
Right.
Right. But even on, let's say you bought on a contract for deed, right? You didn't buy subject to. Mm-hmm. That instance and burdens of ownership is especially important because that's what justifies you taking the depreciation under a land contract when you do not have the title in your name.
Right.
The legal title in your name.
Yep. For sure. Okay, guys, y'all got tax questions. Let's see. Where can I learn more about lease options? Well, Bill's your guy if you want to know about lease options.
Lease options. In fact, we're having a special training on lease options Saturday.
Okay. Is this for your students or something?
No, this is for anybody who wants to register for it. Okay. I'll try to go back later on and maybe put the link in to a Facebook group.
Yeah. Well,
so they'll have a link to register.
Yeah. Put it on the YouTube channel too. We'll try to share it over there and you guys can sign up for that. Well, gosh, Saturday's only 2 days away. So we better get that.
Saturday morning at 11 o'clock.
Okay. So there you go. There's you a free training on lease options. So I say friends don't let friends do lease options.
Do lease options.
But I'll tell you this.
All right. So here's the thing. Okay, because we have difference of opinion on whether or not you should use a lease option. Okay. Lease options can be a beautiful thing, especially if you're using them as an exit strategy. I'm not necessarily saying that you should do sandwich lease options, although if they're properly structured, okay, they can be very profitable. All right. But ordinarily, I do recommend lease options as an exit strategy for some folks who are going to do owner financing. And you use it as a prelude to owner financing because remember, we talked about investment intent. Mm-hmm. Well, what better way for you to demonstrate an investment intent than if you start off with that property in a lease and option transaction and then later convert it to a contract for deed
yeah.
or owner financing or something like that. And that gives you some other benefits as well. But the biggest one, I think, is the establishment of investment intent, because that clearly makes that an investment property. So when you get ready to sell it, you don't have to worry about them coming back and saying, oh, no, this is a dealer transaction. It's not a dealer transaction.
For sure.
Unless all your lease and options end up being 2 or 3 months, and then everything is all of a sudden sold.
Yeah. If it looks like
you get my drift.
Oh, I understand exactly what you're saying. And I wanted to go back and say that I've said that for years and years, because my thing for the last 12 years or so has been, when it's gone, I want it gone. I don't want to look at it again. But it depends on the market, because right now I think we're in a precarious time. We don't really know what's going to happen. We all think we know, but like we all thought 2007, 2008 wasn't happening either. Very similar times to then. But I will say right now, while we're looking for our home, we're considering doing a lease option on our home, because it's a more expensive property. They're the first ones to drop in value. And if you can get a long-term lease with an option, renew your lease on a yearly basis, a 10-year option, and agree on a sales price today, that could be a great thing for you down the road. Of course. And if things turn out horribly, you hand them the keys at the end of your lease.
Walk away.
That's right.
Yeah,
for sure.
And a lease and option. The option is a right to purchase, not an obligation to purchase.
Tell me if this is right, Bill. Somebody shared this link, billwalston.com/register.
That is it.
That's it. So, guys, that's it. Get registered for Saturday if you want to learn more about lease options. There you go. What about this, Vincent? This is a great question for you, Bill. Lease options are not an option in Texas, unfortunately. Now, there's a guy out there.
I'm not sure if they're. Yeah, I think that they are allowed. Now, a sandwich lease option, Vincent, totally is not allowed. You cannot do a sandwich lease option in the state of Texas because of the way that the state statutes are formed. Okay, but if you own a property and you have title to a property, you can do a lease option with that property, even in the state of Texas, or else John Jackson has been lying to us all these years. Because that's basically all the man does is or lease option deals.
Right. Well, I think, and I'm not sure because I haven't taken his training, but I believe his thing is to write it up with the homeowner, assign it to the buyer, so that the buyer is actually lease optioning it from the seller directly.
But my point is, it is still a lease option, and if you are the owner of the property and you're using the lease option as the exit strategy, that's exactly what you would be doing.
Right.
You're the owner of the property. You're using it and you're using a lease option as an exit strategy before you do seller financing on it, which is the same thing. So yes, you can do lease options. Now, I think that there are some special rules and regs, like there are certain disclosures that you have to make and stuff like that. But that's part of the business.
Right.
Okay. Part of the business. But I do agree, Vincent, there is no way that you can do there's no way that you can do a sandwich lease option in the state of Texas.
Vincent said they're allowed, but it's 6 months max.
I'm not sure. I'm not aware of the time period.
Right. Yeah.
That's interesting, though. I'm going to check to see, because that's really short.
Okay. Tony's got a question. Hello and good morning. Good morning to you, Tony. Could we get some specifics on the wording for the operating agreements to set you up for success, not being looked at as a dealer?
Well, the wording in my operating agreement is something like 4 or 5 paragraphs long. Okay, so can't give that exact wording, but basically, Tony, what you want to do is say something like in the section where it says business purpose, you make sure that your business purpose is the buying and holding of real estate for investment purposes. I think would cover most of it, because you're saying specifically that you're going to be buying real estate and you're going to be holding it for investment purposes. And you might want to say that you're holding it for appreciation, or you're holding it as rentals, or you're holding it for whatever. But the key to it is making sure that you're saying something about investment purposes and long-term holding. I have in some of ours that property will not be sold for any other purpose than, and then list like 10 different things that Internal Revenue Service specifically says you can do short term with a property. You can sell a property and not be considered a dealer transaction. One of those is selling to have capital to buy more properties, selling to have a maintenance fund for your other rental properties. Those are all reasons for selling a property very quickly after you purchase it, right? Now, if you don't have other properties and you don't have rental properties that you would need a maintenance fund for, that's like a moot point, but you see kind of where I'm going with that. So if you buy a property and it's one of those that say, oh my God, I bought this property and I got an offer on it and I just can't hold it. That offer is too good to turn down, right? There's some very specific reasons that you can say that you sold that property, okay? You can use it to buy a down payment on another property. Those types of things are valid reasons for you to sell a property quickly and not hold it long term. And some of those we actually include in the operating agreement as reasons that you can sell a property for. And then when you sell a property, another thing, and guys, and this kind of moves outside the taxation part, but I think it's crucial, is you document that in the minutes of your LLC. Okay, if you sell a property, when you sell that property, you actually ought to write that up in your LLC minutes and give the reason that you sold that property, and make sure that it's a valid investing reason to sell the property. And that's also just a CYA, but it's nice to have.
Right.
Have it documented.
Okay. Hope that helps, Tony. Guys, if y'all have tax questions, let's get them. We've got a few more minutes here today. What else did we have on the list today, Bill? I know we had a few things on here about who depreciates.
I think we covered a lot of it.
Have we covered most of it?
I think we have.
Yeah. Okay. So, okay. Well, let's, if you guys have Sub2 tax questions specific to that, go ahead and ask those. We'll get them.
Or any tax question if you because we have the time now.
What do you think, Bill, in your opinion, based on all of your clients and the stuff that you see, is the biggest mistake most investors make, that something simple they could do to minimize their taxes? Right.
Oh, to minimize taxes? Mm-hmm. To not have their LLC structured properly. Yeah. For whatever situation they're in. And it gets back to that old idea. Remember, well, you probably heard this. If you're flipping properties, you use an S corporation to flip properties. Right. Okay. And you use a partnership to hold properties. Mm-hmm. Okay. So that's one of the biggest things, is not structuring and running the LLC properly, mm-hmm. To be able to take advantage of that. Because remember, if you are flipping, okay, that's subject to self-employment tax. So you want some type of structure where you're not having all of that income subject to self-employment tax, and that would be an S corp. Right. So because S corp's not subject to self-employment tax. Do I need to hire one of these big companies and pay them $3,000 to set up my LLC for me? No, I don't think so. You can set your LLC up yourself. Although I don't recommend anymore. This is a difference. I'm not recommending anymore that you go to the state site and set it up yourself. Right. And the reason that I don't is that there's a very good company called IncFile, INCFILE, that you can use to set up your LLC. Now, they charge you, the only thing they charge you is a convenience fee of about $5. And then whatever the state filing fee is for the year. And they'll set up your LLC for you. Okay. They will also act as your registered agent for free the first year, which is why I like it. Now, and somebody says, well, God, how do they make money? Well, they get you on the upsell. Okay, they've got the basic package, then they've got a gold, silver, platinum, what have you, where they give you all these other forms and documents and corporate books and stuff like that you don't really need. So that's where they make their money. But I really like them for filing the articles of organization. The other mistake I see is that a lot of investors will set up an LLC and then they won't maintain it.
Right.
And somebody says, well, how is that related to taxes? Well, it's related to taxes in case of an audit.
Right.
Basically.
Yeah. How many investors, what would you say if you had to throw a percentage out there? Jody's laughing at me now.
You're laughing at me.
How many investors do you see that actually do the initial filing, set up the LLC, and never prepare any kind of operating agreement or anything beyond that initial filing?
Hey,
I think most of them have. I think most of them have an operating agreement because they get a generic operating agreement from somebody. Okay, I think that's another mistake. Okay, in using a generic operating agreement because they really do not fit folks who are investing in real estate. Okay, period. If you go back and read a generic operating agreement, it does not even talk about investing in real estate. So I think a lot have an operating agreement. I think very few go beyond that. I don't think very many have minutes. I don't think very many take advantage of some of the structures like the Augusta rule and hiring their kids and stuff like that, that proper setting up of LLCs will let you take advantage of.
A better question, and I guess a little more direct. The purpose of an LLC is primarily asset protection.
Yes, it is.
I mean, it's passed through. It's gonna come through, and you're gonna pay taxes. Okay.
Well, and here's an interesting thing. Everybody says, "Oh, I've got an LLC now. That's going to save me taxes." That's totally wrong. Yeah. LLCs do not save you taxes. Period.
Right. Exactly.
It is the way the LLC is structured that saves you taxes.
Right. And the way you prepare your agreements are useful in an audit for showing intent and classification on your transactions. Yes. But what percentage of investors would get the asset protection they're looking for if there were a problem because they don't properly have their LLC set up?
It really depends on the state, because in some states the courts are very lenient to idiots who don't follow the rules of setup. Okay, but I think what you're kind of getting to is how likely is it for creditors or sharp attorneys or Internal Revenue Service to pierce the corporate veil is the language that we use, right? And I think most of them could be in danger of that, because one of the things that I see a lot of them don't do is they don't have a bank account for their LLC. They still run everything out of a personal checking account. If they do have a bank account, okay, they always move personal monies back and forth between the LLC and them. Okay, commingling funds, which is an issue. I see sometimes when you have multiple LLCs, let's say that you have an LLC, have 2 or 3 LLCs holding different properties, and you will transfer money from one LLC to another LLC. That's just as bad as commingling, right? It should always be from the LLC to the owner, from the owner to the other LLC, so that it's treated like a capital contribution and a distribution. So there are a lot of things that people do that they can get by with unless they're ever called on it.
Okay.
Does that answer the question somewhat?
It does. It's sort of a politician sounding answer, but we'll take it today. I know what you're saying. And you finally, in the way I thought you would, most of them wouldn't pass. I mean, because
I would say most of my clients, one of the first things I do when I'm working with my clients on tax strategy, because that's what I'm really focused on. The first thing we do is review articles and review the operating agreement. Most of the operating agreements we have to change. Most of the most of the LLC setup, I have to say, stop doing that. Right? It's an issue.
Well, let's go back to this then while we're on the LLC. Vincent asked, how much do you charge to set up an LLC for an investor?
I'm going to give the proper answer to that. It depends.
Yeah.
On what needs to be done. Most of my stuff is just is kind of like cleanup. Right. I do not say, okay, I'm going to set up your LLC from start to finish and stuff like that. I kind of guide you how to do it because it's more cost effective for you. But Vince, if you want to know or if you want to chat about it, just set up a call. DM me on Facebook, and I'll be glad to set up a call with you, and we'll spend a little bit of time answering some questions that are specific to you.
There you go. Okay. Let's see. Can an S Corp take passive losses?
Sure. Because remember that taxes and losses are not taken at the corporate level. And in this case, at the LLC level, they pass through to the owners of the LLC, right? So let's say that you have a passive loss in your S Corp, that passive loss would flow up to the owner of that S Corp. And then it's whether the owner can take those passive losses or not. Okay. Now, remember, there's a difference in the way passive losses can be deducted and how they can be offset. Ordinarily, passive losses can only offset passive income. Okay. But it depends on the nature of the loss of how it's going to be treated tax-wise.
Okay. Matt asked, do you save money on taxes by doing wraps, or do you get taxed heavier because you don't own the asset?
I'm not sure.
I think we need some clarification.
Yeah, I need a little clarification, Matt, on the question, because doing wraps, that's just a way of buying a property. That really doesn't have that much to do with taxes. So I think that you're going somewhere with that. I'm just not seeing the connection.
Okay.
All right.
Matt had a follow-up here. Does the Inc. file give you an operating agreement?
Yes, the Inc. file will give you an operating agreement as part of the basic structure. I think they'll do the articles and an operating agreement, but it's not going to work for you, not as an investor. They give you one of those generic, because remember, they've got all these customers that are having their LLC set up. So they've got to have a generic operating agreement out there that will fit all of these different customers. So it's not customized to you.
Matt says he uses physical address for my registered agent. They scan your mail, give you a business address for $70.
Cool.
Is that a year or a month or what is that, Matt?
It's they probably do that as a year. Mm-hmm. And Inc. file will be your registered agent that second year as well, but they'll charge you the second year. They don't charge you the first year, but they'll charge you every year thereafter if you want them as a registered agent. And that's really a good idea to use them as a registered agent. I don't suggest that anyone be their own registered agent, because you have to give a physical address. Plus, the registered agent is the one who's supposed to get served all the legal documents.
Mm-hmm. For sure.
Right? So I would recommend a different registered agent. When we talk about mistakes when investors set up their LLCs, another mistake that I think they make is to set up a member-managed LLC as opposed to a manager-managed LLC.
Mm-hmm. Okay. Why is that?
LLC should be set up as manager-managed. Because in almost every state, okay, if you set up a manager-managed LLC, then it's only the manager's name that is public record. The members' names are not.
Right.
And so just because you're listed as a manager does not mean that you own any part of the LLC.
Right.
Okay, so you could have, you know how we use nominee trustees, where you can actually use a nominee manager who does not have any ownership in your LLC,
right,
to be the manager that's listed at the state level. Another thing that allows you to do is you can sign all of your contracts and your documents as a manager instead of as a member. I don't want my signature floating around out there saying that I am signing as a member of such and such and such and such LLC.
Right. Mm-hmm.
It's much better to sign as a manager of that LLC.
So if what I heard is correct, you can use your cousin Joe Smith as the manager of the LLC, and he'll be on public record, even
As
though
the
you're a member,
Mhm.
and you can still sign your contract as a manager.
Yes, because all you would have to do is have yourself appointed as a manager at one of your LLC meetings that you should be having.
That's a lot like how a trust operates.
That's
really.
exactly how a trust operates. and so I mean, but that's the way that you can get it done. And you take a look at it and you think, well, that's how these major corporations are. Do you think they have every single member? Do you have they have all their shareholders listed?
Mm-hmm.
No, they have their board of directors, or they have their organizer, or what have you, is listed at the state level.
Mm-hmm. Okay, that's a good tip. Vincent, I think William's laughing because Jody is guilty. That is absolutely not true. Princess Jody is perfect.
Vincent, I think it might be the other way around.
Oh, hey, no, man, don't, no way.
I'll cop to it.
She says she'll cop to it, but you know, anyway.
Previously,
she got her deal done. So
there you go.
That's a tip for you. Yeah. You know, if you have your LLC and you're doing your first deal and your LLC is the seller, you know, that title company's probably, if they're not your title company that know you well, they're probably going to ask for that LLC agreement or that.
Absolutely,
you know,
they will.
Stuff. And if you don't have it,
yeah, you might run into some problems.
Yeah.
All right, and another reason that I just thought of that I knew before too. Another reason to have a manager managed LLC. Mm-hmm. Is that suppose that you have an LLC set up and you want to assign the beneficial interest to the membership. Okay. If you are a member managed LLC, you have to notify the state that the members have changed. Okay. If you are a manager managed LLC, you don't have to notify the state that the members have changed.
Well, that's
so you don't have to make any difference in what happens at the state level. Now, when I say this, I'm speaking generalities because I can guarantee you there's one state out there where that's not the case, and you may be in that state. So it doesn't apply. Arizona is one of those. Arizona doesn't let you do that much anonymity.
Okay. Vincent, I can't remember. Is the operating agreement recorded with the state?
No, it's not.
Okay.
Generally, the only time you have to produce an operating agreement is if you are borrowing money. The bank will generally want to see an operating agreement. If you are closing a deal with a title company, sometimes the title company will want to see the operating agreement because they need to know who they're dealing with. It's just like with a trust, right? That's why most of those places want to see a trust document. They want to make sure that the person who is saying they're the trustee has the right to convey the property.
Right.
They want to do the same thing here with this.
Okay. Hey, Marty, good to see you. Marty's up in Oregon. Do you record the operating agreement or just keep it in a file? I think we just
keep it in a file.
Okay. Amanda had a question. Let's see. What's the best way to keep track of minutes for your LLC? Keep a record of work each day, month, or when you do a deal?
Oh, yeah. It doesn't have to get that complicated, Amanda. When we're talking about minutes, we're talking about big major decisions that a corporation or an LLC is taking. So generally, if you sell a property, you want to make a note of that in your corporate minutes. And you don't have to do it right then. You can kind of jot things down and record them on a quarterly basis, do it on an annual basis, that type of thing. Right. But usually, if it's a major decision, you cover that in a notation to the minutes of the LLC.
Okay. Vincent, I was advised to use my Wyoming Holding LLC to be a manager member for public record. Is that correct?
Advised my Wyoming LLC holding LLC. Okay, so then what I'm hearing is that you have a Wyoming holding company. That's good. Totally agree. Okay, and you have that listed as the manager or the member for all of your other LLCs. And that's not I do that as a member because my Wyoming Holding LLC is the member of the other LLCs. It owns all the little baby LLCs that are disregarded entities. Okay, I don't necessarily list it as the manager because then you're still going to have to sign for the Wyoming LLC. So you've got a contract that you're going to enter into, and it says you're signing for ABC LLC with Wyoming LLC as the manager, and then you've got to sign on it again. It's just so much easier just to designate an individual as the manager of the LLCs, and they just sign. Okay, it can get a little complicated and hard to explain if you are signing for one LLC as the manager of another LLC. Yep. And legally, that's what you would be doing. If you list your Wyoming LLC as the manager of another LLC, then that Wyoming LLC has to sign for that other LLC's documents.
You know, people talk all of these strategies, but in practical use, a lot of times it doesn't work out very well. We're trying to find a title company or
because we make it convoluted.
That, you know, and when they don't understand, their go-to is we're not going to do it.
Right.
So unless
what was the old expression? A confused mind always says no. That's true of title companies as well. If they can't figure out what you're doing,
right,
then they're not going to want to do it.
Yeah, right. For sure.
So Vincent, what you were setting up basically is you have Wyoming LLC and it owns ABC LLC, or it's the manager of ABC LLC. Okay. When ABC LLC goes into a contract, enters into a contract, then the Wyoming LLC has to sign as the manager, and you have to list the Wyoming LLC as the manager legally. And I know a lot of people don't do that, okay, but that's really what is supposed to be done if you do your structure that way. So I agree with having, let's say that Wyoming owns ABC LLC. I'm fine with Wyoming being listed as the member at the state level. That still gives you anonymity because Wyoming LLC is not, you know, public, right? But I would not list Wyoming LLC as the manager. I would list an individual as the manager so the manager can sign. Yep. But you can cover all that in an agreement, in your operating agreement, or in a resolution as to who is going to be the manager and who is not going to be.
Okay. All right.
All of these rabbit holes we can get into.
Well, we can get into them, can't we?
I tell you.
Yeah. Guys, don't forget, if you want to learn more about lease options, Bill is doing a Zoom meeting. I'm assuming that's what it is. And you can register at billwalston.com/register. And you can also contact Bill at billwalston.com if you have any questions, or, of course, message him on Facebook.
And feel free to message me on Facebook.
Okay.
I don't have a problem with that if we're friends.
Yeah. So if you guys...
If we're not, we should be.
Yeah. If you guys got any questions, just send those to him. Hey, man, we appreciate you being here with us today and sharing all the tax stuff. So we'll have to do some more of these things. We hadn't talked for a while about some of the new tax stuff just in general, and just some of the podcasts we've done in the past. We might need to redo some of those. But all right, guys, we appreciate your questions. Appreciate y'all joining us today. Don't forget, if you're over on YouTube, to subscribe to our channel. We release videos almost every single day, sub2tv.com. And if you're looking for the most affordable coaching on the planet, $7 a month, man, that's the price of a latte at Starbucks. You can join us at $7 coaching. Who coaches for $7? Bill, do you know anybody else?
You?
$7, man.
I'm just guessing.
If you find a more affordable one, let me know so I can join. Man, I'm always looking for some good coaching too. So anyway, we appreciate you guys being here with us, and we'll catch you next Thursday. Y'all have a great week. Talk
Have a
to
good
some
one.
sellers and buy some houses.